Good morning and welcome to the Moneycontrol live stream. You are watching Markets with Santo and CJ. Well, it seems like we are in for a choppy start as markets looks to take a pause after 2 days of strong pullback after a 6-day selling streak, right? If you look at the Nifty futures on the Singapore exchange, they're indicating a flat to negative start for our markets. Even though the US markets were quite strong yesterday, Santo, we saw 1.5 to 2% rise across S&P 500 to the Nasdaq 100 index, and overall globally also European markets were quite strong. But Asia today in the morning is a bit choppy, and it seems like that sentiment has also passed on to us.
Well, CJ, see, again, market is trying to gloss over the facts. The hard fact is that again yesterday the Fed has said that it will do whatever it takes to curb inflation. You had seen a similar reaction about 2 weeks back where the Fed hiked rates by 50% and the market said, oh, it's not 75, it's just 50 and let's celebrate, and then you know what happened. Something similar seems to be happening here. The market, for whatever reason, is not or has temporarily taken its eyes off the reality. You're seeing a strong short covering rally out there, but you know, CJ, I would always say beware of bear market rallies. They keep pulling you in and eventually, you know, you end up much poorer than where you were at the start.
Well, I disagree with your categorization of this as a bear market. I totally feel that this is a deeper correction in a larger bull market. And also, among all the bad news that the market has had to digest over the past 2 months, yesterday actually we saw some bit of a good news coming in, and that was from the US economy, wherein if you look at the April retail sales data, although it was slightly below expectation, it was still quite strong on an annualized basis. And that goes to show that consumers, while prices have risen, the demand has not, has not slacked so far. It seems that the US economy is still doing quite good, and probably investors were taking a bit of a heart from that. Plus, if you look at consumer-centric companies like Home Depot in the US, they ended up raising their guidance for the full year 2022, and that goes to show that some consumer companies are still very buoyant about the US economy, and if the US economy is strong, that is largely to be a good news for the broader global economy.
But CJ, it's not necessarily true that, you know, the way US economy reacts, you're going to see a similar kind of reaction in India also. Again, look at the inflation numbers, you know, look at wholesale inflation now, you know, it's like at the highest in almost 10 years, and it's been consistently high. Look at even consumer inflation for that matter. All this will at some point start reflecting in companies' earnings and also consumer sentiment before long. Already we are seeing some bit of it. This is only likely to intensify as we go ahead, and that's what makes me very cautious, CJ. You know, Q4 numbers on the whole, they were good. You know, if you take broadly, they have been quite strong, but they're still not fully factoring in, you know, all the higher commodity prices, because, you know, companies still had old inventory. Now, when that inventory gets repriced, this is when you're starting to see the pain hitting home. Also the fact that there will be slowdown in consumer spending as well. So I would be a little cautious. I would say that, you know, whenever you see the market rallying, just take some cash off the table.
Santo, markets always tend to discount the future, and so far the markets are not discounting a future wherein earnings growth estimates have to be cut down very, very sharply. So we have to still wait out for the June quarter earnings to come and see how the market reacts. But so far it seems like we have formed another bottom around that 15,700 odd level, which was also the bottom that we made in the March 2022 slump. And if this double bottom scenario plays out, then probably this pullback might have some merit. So watch out for that one.
So you forget the double top part of it, right? Again, the market has been struggling to, you know, sustain at higher levels. But that said, let's quickly look at the stocks that we have on our watch list this morning, starting with DLF. Well, not a great set of numbers for the fourth quarter. Now, given that, you know, there was so much excitement over the real estate market, you know, the growth in sales is not really all that great. Besides, DLF also turns out to be one of the most expensive, among the expensive names in the segment right now, and they're a better place, I would say. Interest rates are rising, that clearly will have a dampening effect on demand for homes. So all put together, I think real estate is a sector where one should be a little cautious about.
Santo, you know, given accounting for the fact that we had a third wave in the March quarter, I feel that DLF's number were quite resilient and quite good. I mean, in a half quarter where half of the sales period was taken away by the third wave, and then you had the Ukraine-Russia war happening, I feel that they have done quite well to come out with the numbers that they have come out. does. If you look at, see, the argument for real estate has flipped upside down recently because of the rate hike, and everybody has got fearful that what will happen now if interest rates keep rising for home loans. But if you speak to the industry, their indication is that even if home loan rates rise by 50 to 100 basis point going ahead, that will not hurt demand materially. Demand will only start falling down for home loan when that rate moves beyond 100 basis point. So at this point of time, there is still cause for optimism that the demand for housing and demand for residential housing will continue to remain strong in the coming quarters as long as home loans do not go beyond the pain point, right? The pain threshold. Also, if you look at the DLF stock itself, the stock has also corrected materially over the past few weeks since the rate hike, along with the rest of the realty sector. I feel that given the longer term growth prospects of the real estate space, given that we are now in a new real estate bull cycle, this correction period is actually a good time to accumulate the stock. If you look at what UBS is saying, they are suggesting that DLF could deliver above industry pre-sales growth as well as cash margins going ahead in the medium to longer term. They're not even talking about just the next 1 year or 2 year. They're talking about a 3 to 5 year period. So from my perspective, this correction is actually a good entry point for those investors who missed out on the rally last year.
Well, CJ, if you look, the stock has not been performing for a while now. You know, the kind of highs that you've seen some time back, it's nowhere close to that. So technically, it doesn't seem to be on a very firm wicket for the time being, as you always keep referring to.
Well, one stock that is on a firm wicket is Bharti Airtel. Wow. The company flexed its earnings muscle in the March quarter and came out with a very, very strong showing, which basically reflects its renewed dominance in the sector, even though it is still a number 2 player. If you look at the ARPU that the company came out with, the average revenue that it makes per user, it grew about nearly 10% or more than 9% in the March quarter on a sequential basis. Also remember, they also added new users during this quarter, which goes to show that the company is exhibiting a lot of pricing power right now in the industry, and that can only be good for the company overall. Also, if you talk to a lot of the analysts, they feel that given that 48% of IoT infrastructure in the country is now dominated by Bharti Airtel's network, and overall expansion that Bharti Airtel is doing in terms of efficiencies and bring in its broadband and digital internet space, Bharti Airtel at this point of time is now at the forefront of the digital revolution that we have been seeing. Jio was the catalyst for this digital revolution, where it seems Bharti is slowly and steadily catching up. And for me, therefore, this recent correction in the stock, although it's not much compared to the highs, if you look at it, maybe it's down about 10 to 15% from its recent high, is a good entry point for investors who are looking to ride the digital story in the telecom space over the next 4 to 5 years.
CJ, we had an argument over this just 2 days back, and I'm not, my side of the argument doesn't really change, although you have added the latest fourth quarter numbers. The stock has started correcting some time back, okay, despite the fact that it was known that, the fourth quarter numbers are likely to be strong. The market has already discounted that. Now, what's the market right now focusing on? I think it's the fact that tariff hikes were the big story for telecom companies. Of course, I take it that, when you're looking to play the telecom sector, there are not too many stocks to choose from, and the really strong ones right now are two, Reliance and Airtel. Okay, Vodafone is there. I think you pointed out that last time also. It's pretty much there. But if you're looking for a very sound name, then these are just two companies. Because of which, I think a lot of players have hopped onto the bandwagon, and which you've seen in the stock's performance over the last 1 year. It's rallied quite a bit. In fact, it's rallied by almost close to about 30-40%, and it's been outperforming the Nifty so far this year also. But now I think there's some bit of fatigue setting in, and the tariff hike story, for that matter, could face some headwinds now because of inflation, and especially on the rural side of the picture. This is a very price sensitive segment, so they won't be able to push price hikes through. Bharti Airtel is now going to bid for 5G spectrum, which means that it will need to take on more debt. And lastly, don't forget, fuel prices have been quite high. So the price of diesel going up also means that higher operating expenses for Bharti Airtel.
Santo, you talk about going into plays which have stable earnings in a period of market volatility. These are defensive plays, right? There is no company out there probably with as stable an earnings profile and earnings outlook as Bharti Airtel, probably besides its only chief rival Reliance Industries. So for me, even from a very defensive perspective, Bharti Airtel makes sense. While I am not looking at it from a defensive perspective, because I think that the company's growth trajectory makes it probably one of the best growth stocks out there to buy. But even if investors want to, hedge their bets in this current market, Bharti Airtel is a gift that both set of investors can be very happy with.
You're saying don't look a gift horse in the mouth. Dr. Pathlabs, that's the third stock on our watch list. Now, we've been again discussing this quite a few times. You know, I've always been bearish on the stock, and I maintain that even now. See, the stock did very well, when COVID was at its peak. Volume growth was driven largely by COVID and other related tests. But those tailwinds now have receded considerably, because of which you're seeing pressure on the earnings, and also there's severe margin pressure because other costs too have been going up. But the biggest problem for players like Dr. Pathlabs is that the entry of bigger, stronger players and disruptive pricing by some of them. Okay, now this is likely to lead to severe margin pressure in the quarters ahead. Now, it wouldn't have been so much of a problem, but for the fact that valuations have been quite high for Dr. Pathlabs for a while now. That was okay as long as the growth was there, but now that growth rate rather, it's not so much about growth as much as it about the pace of growth. That pace of growth looks suspect, at least for the next few quarters. So I think it makes sense to kind of be a little cautious on the stock.
Santo, you are totally underestimating the ability of one of the industry leaders to actually get through this period, right? Yes, margin squeeze is happening because of the sort of adverse pricing that the entire diagnostic space is seeing. Now with COVID tailwind away, it seems that the industry is normalizing and going back to the space that it was prior to COVID. And with the entry of a lot of new players backed by huge amount of capital, such as private equity players and all, it seems there is cause for concern that growth, margins will slow down, profitability will go away as these sort of companies like Dr. Pathlabs try to maintain their market share. But this is something that has not happened to the diagnostic sector for the first time. Even 6-7 years ago, the sector was going through a high period of competition, but Dr. Pathlabs emerged out of that competition with greater market share and greater profitability. For me, the company is investing highly in trying to expand its network. The hub and spoke model that it has is now expanding into the rural tier 2, tier 3 urban towns as well as the rural space. They are trying to get home delivery of testing and home testing to beyond the tier 1 or metro cities. So for me, Dr. Pathlabs is doing both the sides of the story very well. And if you go by what Citi is saying, the street is underestimating the management's ability to ride through these challenges and emerge stronger from in this new sort of a market and industry. And I totally believe in what Citi is saying. I think the street is underestimating it, and while valuations are high, I don't think they're high enough for you to be discouraged to enter the stock in every correction going forward.
Well, it's not just the problem with Dr. Pathlabs in general. If you see the entire diagnostic space, all three stocks right now, Metropolis Health, Thyrocare, as well as Dr. Pathlabs, all of them have almost fallen 50% from their 52-week highs. So, overall the market seems to have a bearish view on the
so
diagnostic
this correction
segment.
is actually largely driven by the fact that COVID tailwinds that they had, where you saw a massive ramp up in testing. The pricing power was decently there, although government had capped the prices. Those sort of tailwinds have gone away. So therefore, the market is no longer expecting those sort of strong earnings that they displayed in the past 2 financial years. And now the market has to also reassess the growth prospects a lot of these companies in view of the new competition that is coming in. So for me, market will take time, but I think they will overall appreciate those companies which have a strong management bandwidth to get through these challenges. And I feel Dr. Lal is one of those stocks. I don't know about the others, but Dr. Lal definitely is. Talking about one stock where the sentiment might take a hit is BPCL. But before we get to BPCL, the opening bell is about to ring. And the market has opened on a firm foot. The Nifty is higher by 3%, and the Sensex is higher by about 0.3% again.
Strong market breadth. About 1,700 stocks are trading higher than the previous close, while about 242 stocks have declined over their previous close. And well,
if you look at the mid cap, the bank is doing well. Nifty mid cap is also growing from strength to strength, now higher by 0.5%. So that is quite good for the second line stocks and the third line stocks. As you mentioned, the advance and decline is quite good. Bharti Airtel has gotten off to a very strong start, higher by nearly 2% after the strong set of Q4 numbers. So overall, the picture is looking quite good. Santo, third consecutive day of a strong start for the bulls, and all that I hope is that this continues going forward.
Well, let's see, CJ, although I would like the markets to go up, but one can't ignore the reality as well.
Well, coming back to BPCL, news has emerged that the government is now probably chucking its plans for privatization, which was such a big trigger for the stock's humongous rally that it saw in 2018 and 2019, and even through the course of the COVID period. Now, Reuters has reported the government may look to sell a lesser of a stake. That means that they will probably look to sell only 25% stake in the company, which, while it may trigger an open offer, but it will probably not result in a wholesome privatization that the earlier plan had projected. Now, for me, retail investors unfortunately have been totally trapped on the stock, right? The stock has corrected very massively from the highs it had made about a year and a half ago. Retail investors had jumped onto the stock because of the strong, research reports that had come out at that point of time in 2018 when the privatization news flow came in, and everybody thought that once BPCL gets privatized, then there is no stopping this, state-run behemoth. There will be efficiency gains, there will be cost savings, and the overall outlook for the entire sector will change. Well, all of that is now down in the drain. And for me, this has become a sort of a sad story of privatization that could not happen. And it also goes to show you the challenges that government faces when it's trying to privatize a lot of these assets, which may not find those sort of buyers that it's looking for in the external market. And for me now, BPCL is a story of downgrades going ahead. The valuation has already taken a knock, and it might take further knock, given that a lot of these companies are facing marketing losses because of their inability to pass through majority of the crude oil price rise that we have seen over the past 4 to 5 months. So BPCL for me now is probably just cut your losses and take whatever money you have left, just take it home and probably start investing somewhere else.
Well, just look at the BPCL price, CJ.
Yeah.
It's been flat despite this news coming out. So
because a lot of it is steadily been
exactly,
priced at,
exactly. That's what. So going short probably on the stock at these levels makes little sense. Although the upside now looks limited, I'll take that. But one need not be so bearish also. That's because refining margins right now are at near record highs, and it's likely to stay that way for some more time because there is very less supply which is coming on stream. So that is clearly the biggest factor in favor of BPCL at this point in time. And also, don't forget the fact that this stock, at some point when there is these unwinding of long positions, the valuations do become attractive, and the fact that the government will have to raise fuel prices at some point. There is marketing losses for now. I mean, there's no denying that, but the government has indicated that it will increase fuel prices at some point, which will help them cover the marketing losses. So marketing losses covered, and you have strong refining margins. So
I'm very skeptical that the government will, or a lot of these OMCs will go ahead and raise prices to the fullest and recover a lot of those losses that they have seen on the marketing side. And while the refining margin has been strong, Santo, but a lot of that gains are being cut and being undercut by the marketing losses that the companies like BPCL and HPCL are seeing. So I'm not so sure. While optically earnings might look good, because let's not forget BPCL also has a lot of inventory, and PSU refiners generally tend to benefit from inventory repricing of the inventory in terms of when crude oil prices rise. So you might see a good set of March quarter numbers and maybe June quarter numbers as well. But overall, the growth prospects that the privatization bit could have brought, that has totally been undercut now, and I therefore don't see this either as a short bet or a long bet. Is something that probably you just get out or maybe hold for a very, very long time in the hope that someday there is a turnaround.
Well, the last stock, VIP Industries, it's a play on the reopening of the economy and the fact that more and more people will be traveling now. A slightly disappointing set of numbers for the fourth quarter.
Yeah.
December numbers were strong. That's also because that's typically the time when people travel again. So this quarter is likely to be strong because of more people traveling. This is the holiday season, and the company has said that it is well on track to achieve the 2,000 crore revenue guidance which it had mentioned last year. margins have been a bit of a problem. There's been margin pressure, but the company is trying to get around that by changing its sourcing. So this stock has been underperforming for a while now, but now with the economy opening up, more people traveling, I think you're likely to see an uptick here.
Santo, VIP is definitely a great story given that it's involved in the reopening theme, but I'm a little disappointed by the guidance and the aggressiveness that the management has shown in the con call. It seems like they are still being a little conservative about their growth prospects, and probably that could play out in the stock as well. If you look at it right now, it's just about flat despite the guidance that the management has given, and I think investors are also reading it in the same way, that the guidance is a little tepid compared to the entire build-up of the reopening theme and the sort of prospects that, if you go by what hotel industry is talking about, they are so bullish on growth, they are so aggressive on the sort of market share and growth prospect that they see from themselves. But at the same time, VIP, which should be another proxy in the entire travel theme, it's displaying a little bit of a conservatism. So I think that might play against the stock in the near term for the time being.
Well, with that, it's a wrap on this edition of Markets with Santo and CJ. Thank you for watching, and do share your feedback in the comment section below.
And do follow us on the social media links that you can see at the bottom of your screen. We will catch you live at 3 p.m. with all the day's update. But in the meantime, do keep tuned to moneycontrol.com for all your financial news and the Moneycontrol app. We'll see you later. Thank you.
Good day.